But under this short-term chart noise, let's drill down into the footprints which are ultimately leading to a real supply-demand gold price to emerge. Now, over the last 2 weeks of paper-driven tariff flip-flop, a series of gold revaluation footprints have actually been revealed. The real story is that gold has not actually risen in price. It's just that it requires 3,300 more dollars just to buy the same ounce, kilo, ton of gold. And what we're about to see is the next pivotal gold price revaluation event, which will once again incentivize every single foreign central bank to race again to swap more dollars to buy the same ounces of gold.
In 1971, Nixon severed the dollar's link to gold to prevent foreign central banks from draining U.S. reserves. This triggered the launch of COMEX gold futures, a tool deliberately designed to use paper dilution to suppress gold's role as real money. Concurrently, AndrewMaguire predicts a major gold revaluation by the 55th anniversary, targeting $8,000 to $9,000, which will force central banks to race for physical gold. Gold revaluation discussions exist within a broader context of evolving monetary systems. Throughout history, monetary regimes have transitioned approximately every 30 to 50 years as existing systems encounter their structural limitations. The current dollar-centric system, established in 1971 when the U.S. officially closed the gold window, has operated for over 50 years, suggesting historical precedent for potential transition. Physical gold markets have reflected this shift, with delivery requests at major exchanges, such as COMEX and LBMA, reaching historically high levels. Institutional buyers increasingly prefer physical possession over paper gold instruments, suggesting growing concerns about counterparty risk. The short-term gold price is an illusion created by derivatives players exploiting thin liquidity during holiday seasons. The gold price is an illusion created by derivatives players. AndrewMaguire says the paper market's Achilles heel is now exposed. This growing stress could soon destabilize the wider $2 quadrillion derivatives market, with gold at its very core. Ultimately, Maguire warns that the exit of large hedging flows from the LBMA and CME will eventually force the bullion banks into full compliance with Basel III, accelerating the shift from paper to physical pricing and exposing the fragility of dollar-based gold suppression. The implementation of Basel III's net stable funding ratio regulations has fundamentally altered how financial institutions approach gold holdings. Unlike gold, silver isn't Basel III NSFR compliant, creating a different set of market pressures. However, silver is experiencing its own structural transformation as global FX pricing mechanisms shift away from traditional London benchmarks. Before we dive into AndrewMaguire's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Now, the elephant in the room is the passing of the August 15th, 1971 54-year anniversary of where Nixon ended the Bretton Woods system, announcing the suspension of the the dollar's convertibility into gold. Now, foreign central banks were racing to exchange dollars for gold, and what that was doing was draining U.S. Treasury holdings from 20,000 tons to around 8,000 odd tons. And had Nixon not ended the convertibility, all US gold would have flowed out. So, Nixon's shock, which was, as I say, on the 15th of August, it priced gold at $35. However, this did not stop foreign central banks going to the marketplace to sell their dollars for gold. And the next day, just one day later on the 16th, the price of gold had spiked higher by 25%. It doesn't seem like a lot because it was $35, but it moved up to $43 per ounce. Now, foreign central banks then continued to go to market to swap their depreciating dollars for gold. And by December 1974, the gold price had risen by 450% to $195 an ounce. And with the gold price getting away from the dollar peg, further and further away from the dollar peg, by no coincidence, this was the very month that the US COMEX gold futures market was launched. Now, the COMEX was trading long before that in the 30s, but gold had never been a component of that. So just to really illustrate, in an uncovered 1974 State Department cable, WikiLeaks revealed that in association with the local London 400-ounce gold markets, the COMEX had deliberately been designed to create volatility in gold prices, and the idea was to discourage US citizens and foreign investors from holding physical gold by making prices far less predictable and at the same time indirectly supporting the fiat currency stability. In other words, just pumping up the dollar versus gold. And this was enabled by the COMEX adding thousands of tons of undeliverable paper gold into the daily trading mix, diluting the real deliverable gold price. Now, official gold price suppression maintenance always required a cartel of market-making bullion banks who, through position concentration, they were able to print as much paper gold as was necessary to control a rising global gold price. Now, well, if we now fast forward, and here we are, 54 years later, and we're recording this on the 20th, so 5 days ago, with gold price really in dollars 9,500% higher, averaging $175 per year, 175% per year, at around 3,300 at the moment, or 3,340 or whatever it is. Yet the real story is that gold has not actually risen in price. It's just that it requires 3,300 more dollars just to buy the same ounce, kilo, ton of gold. And what we're about to see is the next pivotal gold price revaluation event, which will once again incentivize every single foreign central bank to race again to swap more dollars to buy the same ounces of gold. Now, we'll look at the footprints that assure next year's Nixon shock anniversary, the 55th one, will come around with gold having been revalued against the dollar. So not only, really, what would my question be here? What is the question? How many dollars will it actually take to buy the same ounce of gold next year? So a similar 55th year, 175% higher physical price would price the dollar gold at around $8,000 to $9,000. Now, US gold price revaluation will first force US gold reserves to become Basel III compliant. Now, with most of Europe away on holiday over the last 2 weeks, vapor-thin liquidity has given the trading advantage to the derivative actors in gold and silver. But while this leveraged supply has driven another opportunity for officials trying to mark as many of remember those Office of the Comptroller bets that have been putting up the charts about? So they want to mark as many of these bets because they relate directly to US Treasury reserves. They want to mark them to market as best as possible into first options expiry and first notice day on the 28th. So options expiry is next on the 26th and first notice is on the 28th. But under this short-term chart noise, let's drill down into the footprints which are ultimately leading to a real supply-demand gold price to emerge. Now, over the last 2 weeks of paper-driven tariff flip-flop, a series of gold revaluation footprints have actually been revealed. Now, cutting to the quick, ironically, almost to the day 54 years ago, with the dollar redeemability being usurped by the China yuan one-to-one Basel III compliant convertibility into gold. So you hold the yuan, it's backed by gold. The irony of it. And the COMEX diluted prices are being targeted through the backdoor Achilles heel, which is, as we've said multiple times, the exchange for physical mechanism that little mechanism that allows for COMEX synthetic supply to move into the Basel III compliant markets for delivery. The accompanying dollar-based paper gold suppression tool that finally blew up, coming dangerously close to blowing up the interconnected $2 quadrillion derivative markets, of which gold is the primary, the largest, really the largest shoe to drop. Now, let's first drill down into the footprints. Then we're going to report on the very large exit of LBMA CME hedging flows, which is actually going to force these bad actors to embrace full Basel III compliance. We kind of looked at that last time, so I won't dwell on it, but that is what we noted. Now, cutting through this past 2 weeks of, as I say, the thinnest European holiday market liquidity, where a single trade can move the price. This tariff tantrum exposed, what it did was expose the need to quickly address the LBMA CME cartel's paper to physical disconnect.
Silver is rapidly breaking free from LBMA control. For decades, a cartel of bullion banks used extreme leverage, sometimes 500 paper ounces for every real one, to create fake prices. Now, liquidity is shifting to new physical exchanges that is finally giving silver a sound price. The paper system is collapsing. New benchmarks in Shanghai are setting a truer supply and demand price, making silver a far more attractive reserve asset. Russia is already stockpiling aggressively, and for the first time, even smaller nations can directly access physical silver to build their own reserves. Central banks, particularly in emerging markets, are aggressively accumulating gold and silver as hedges against fiat currency devaluation. China, Russia, and Turkey have led the charge, with gold reserves in EM central banks doubling since 2015. Silver, though less prominent, is gaining traction as a complementary asset. Silver faces a $100 per ounce rally potential, driven by a 117.7 million ounce structural deficit, 1.2 billion ounce annual demand exceeding supply, and green energy-driven industrial needs. Ultimately, he argues that the real silver price is beginning to emerge globally, and this unfactored sovereign demand will drive prices much higher, beyond the control of Western paper markets. Let's get back to the interview.
Question, as this is exactly what we're seeing now that silver market paper settled liquidity, alongside producer financing initiatives, are rapidly leaching out into the Chinese-backed 7-second settlement BRICS-facing physical exchanges, where you have to own a bar before you can buy and sell it. Now, very short term, thin holiday market liquidity aside, in the larger picture, silver has largely escaped the LBMA stranglehold, opening up buyers from all over the world. Now, historically, up to 500 1-to-1 paper to silver position concentration, that is, yes, 500 paper ounces to 1 paper ounce of silver. That position concentration was admitted by industry apologists in the past, and it's enabled the LBMA silver cartel to have full control of the cash-settled, unallocated silver foreign exchange market. Now, these synthetic silver fixed prices have historically been so diluted with unallocated, undeliverable cash-settled silver contracts, they don't reflect a real price, whereas central bank sovereign buyer, which you refer to, where they could take delivery, it was just too volatile. And bearing in mind, the underlying leverage bars have diluted the real physical price. So absolute chaos. Now, the trouble with local London pricing, it's been so dilutive of the real physical price that 3 things really have come into play. Massive injected price volatility. And if that didn't dissuade a buyer from looking at silver as an investment asset class, if delivery actually was demanded, extremely large premiums over the spot fixed price had to be paid to obtain physical bullion. In other words, bilaterally settled, completely different, separately to what this ludicrous fixed price was. And this has made a farce of the global fixes. But even worse, very large physical orders have been refused, and we've experienced this in the past ourselves. Now, because a very small group of LBMA bullion banks controlled really the legacy silver market, they're no longer fully controlling it. And yes, we're talking about UBS, Deutsche Bank, JP Morgan, Scotiabank, and satellites. What they would do is they'd lock down the bullion banking arrangements with the refineries, alongside forward purchasing all the refineries' annual production. So any buyer seeking to backdoor it and circumvent the cartel, because it hit the banking network, it was immediately red flagged, warned, and then you'd receive a warning that you'd be blacklisted if you persisted in trying to take delivery. Now, however, with silver now being priced in real physical exchanges outside the LBMA cartel's influence, where a seller of a silver bar has to first own it and a buyer of that bar has to take physical ownership of it, a real physical price is beginning to emerge in the SGE benchmark exchanges, where it's now possible to buy any quantity of silver at a physically determined supply-demand price. And with volatility greatly reduced, hedging these purchases is far less expensive. And that makes it very attractive for other national currencies to invest, which is, again, I think we covered this last time, but it's the 8th largest gold producer. And they're aggressively stockpiling silver as a tangible reserve asset, with silver now available in any size for small nations to access. This largely unfactored real physical demand is going to drive a much higher true supply-demand price. It's just starting to evolve. The Loco London fix is still dilutive, but increasingly benchmarks a direct producer to end user price. So any discrepancies are being arbitraged. Now, LPs report continued accumulation of underpriced LBMA CME silver is currently in the BRICS crosshairs. So with US-driven silver futures, and we just saw it again, while US silver futures got sucked into the thin liquidity vortex this past week, LPs indicate there's too much physical interest at spot $38 for it to be kept below. And obviously we saw because the options positioning suggests 37.30 as the option sweet spot, and that the Fed has a silver short position, OCC silver short position through its agent banks, you can darn well expect that they are behind trying to market below. They don't have silver. They can buy gold, but they can't buy silver without disrupting the entire silver ecosystem. Now, of particular note, and far too obvious, was Tuesday's farcical futures-driven sell-off that waited until silver had fixed, and then synthetically drove the spot FX silver price trade into an overnight Wednesday, this is the Wednesday lows, 9-cent premium to backwardated silver futures. In other words, the spot premium was trading at 9 cents an ounce higher than the futures market price, literally making a farce of this whole futures market, this price discovery mechanism. It didn't go unnoticed, and it's been arbitraged. And there'll be a price to pay as very large buyers locked in these massive futures discounts for physical delivery. And just as we saw as we saw in August gold futures, its first notice, and the physical buyers coming in, evidencing the largest on record backdoor bullion loadouts in gold this month.
Central banks are increasingly looking to bolster their gold reserves, and they are turning to mines in their backyard to source the yellow metal. Whether through formal revaluation or other mechanisms, gold will likely continue serving as a monetary reference point as the global financial system navigates current challenges. Recent gold price forecast models suggest continued strength regardless of policy decisions. Will governments and central banks adapt to a world where physical gold and silver dictate monetary power? Or will they fight to defend a failing paper-based dollar system? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.